Good evening. Thank you for joining me.
Gold just crossed $4,800 per ounce. That is not a typo. That is not a projection. That is the spot price as of the third week of April 2026, higher than any price in the 5,000-year history of this metal. And here is the contradiction that should stop you in your tracks. The financial media is still calling gold a hedge, a safety trade, a thing you buy when you are scared. But central banks are not scared. Central banks are not hedging. Central banks are repositioning. They bought 863 tons of gold in 2025 alone, the fourth consecutive year of purchases that dwarf every historical average. They are not reacting to a crisis. They are preparing for a structural shift in how the global monetary system works. And the most unsettling part is not the price. The most unsettling part is the math underneath it. Math that suggests what gold has done so far is not the move. It is the warm-up. If you leave now, you will miss the three structural forces that explain why the institutions are buying gold at prices that every textbook says are too high, and why they are not stopping. The confusion is understandable. Headlines make gold look like a simple trade. Geopolitical fear goes up, gold goes up. Tensions ease, gold pulls back. Buy the fear, sell the calm. That is the surface story, and it is not wrong. It is just incomplete. Think of it like an iceberg. The visible part, the price chart, the daily moves, the news cycle, accounts for maybe 10% of what is actually happening. The 90% below the surface is where the structural forces live. Debt mathematics, reserve currency mechanics, institutional balance sheet restructuring that takes years, not days. The surface moves in days. The structure moves in decades. Here is what makes the confusion paradoxical. According to the Joint Economic Committee's March 2026 debt update, the United States added $2.64 trillion to its national debt in a single year. That is not during a crisis. That is not during a war on American soil. That is the normal operating cost of the United States government in what the White House calls a growing economy. Not a recession, not an emergency. A year of supposed growth, and the government still borrowed $2.64 trillion to keep the lights on. While the media debated inflation data and rate timing, the institutions that manage sovereign reserves looked at that number and drew a conclusion the headlines have not caught up to. The news is showing you the tip of the iceberg. The mechanism is underneath, and the mechanism starts with one specific trigger. On March 17, 2026, the United States national debt crossed $39 trillion for the first time in history. It took the country from its founding in 1776 until 2012, 236 years, to accumulate its first $16 trillion in debt. It then took just 14 years to add the next $23 trillion. The debt hit $38 trillion on October 23, 2025. It took only 145 days to add another trillion. That pace is accelerating, not slowing. Think of a dam holding back water. A dam does not fail because one crack appears. A dam fails because dozens of small cracks form across the structure, each one manageable on its own, each one ignored because the wall is still standing. The cracks in this dam are not hypothetical. They are published daily by the U.S. Treasury. As of April 3, 2026, according to the Joint Economic Committee's monthly debt update, the gross national debt stands at $38.98 trillion. Debt held by the public is $31.41 trillion. The total amounts to roughly $114,000 per person or $289,000 per household. The rate of increase has averaged $7.58 billion per day over the past year. That is not a rounding error. That is $315 million per hour, $5.26 million per minute. Every 60 seconds, the United States government borrows more than most families will earn in a lifetime. To put that in physical terms, $1 trillion in $100 bills would fill 10 football fields stacked 9 feet high. The United States is now adding that volume of debt roughly every 146 days. The stack grows taller while the floor beneath it grows weaker. The Congressional Budget Office, in its February 2026 baseline outlook, projects the federal deficit will reach $1.9 trillion in fiscal year 2026 alone. By 2036, the annual shortfall balloons to $3.1 trillion. Debt held by the public is projected to surge from 101% of GDP today to 120% by 2036, eclipsing the previous all-time record of 106% set in the aftermath of World War II. And this is where the trigger connects to something much larger, because someone has to lend that money, someone has to buy those treasury bonds, and the buyers are changing. The Federal Reserve is caught in a structural trap with no clean exit. If it cuts interest rates to reduce the government's borrowing costs, it risks reigniting inflation that took years to bring under partial control. If it holds rates steady, interest payments on the existing debt continue to compound. If it raises rates, the borrowing cost explodes further. According to the CBO's February 2026 baseline, net interest payments on the national debt will hit $1.04 trillion in fiscal year 2026. That number deserves plain language. The United States government will spend more than $1 trillion this year on interest alone, not paying down the debt, not building anything. Just interest. In 2020, interest payments were $345 billion. In 6 years, they have nearly tripled. The CBO's February 2026 long-term outlook projects this will double again to $2.1 trillion per year by 2036. Over the next decade, the cumulative interest bill is projected at $16.2 trillion. By 2048, according to the American Action Forum's March 2026 analysis, interest becomes the single largest federal expenditure, larger than Social Security, larger than defense. Meanwhile, the entities that historically absorbed this debt are stepping back. China has been reducing its treasury holdings for years, and the shift is now geopolitical. Russia and China now settle more than 99% of their bilateral trade in rubles and yuan, confirmed by Finance Minister Anton Silvanov in November 2025. Their trade exceeded $250 billion in 2024, with $0 involved. Approximately 90% of India-Russia trade also occurs in local currencies, per Deputy PM Denis Manturov's late 2024 statement. Brazil and China signed a yuan-real settlement agreement in 2023, BRICS Plus. Now 10 member nations representing roughly 48.5% of the world's population launched a pilot of the unit on October 31, 2025, a gold-anchored settlement instrument backed 40% by physical gold and 60% by BRICS currencies. And what are these nations buying with the dollars they no longer need? Gold. According to the World Gold Council's January 2026 Gold Demand Trends Report, central banks purchased 863 tons in 2025. Poland added 102 tons. China added an estimated 225 tons. India added approximately 100 tons. Turkey added roughly 95 tons. More than 40 central banks increased holdings. The World Gold Council's 2025 Central Bank Survey found that 95% of respondents expected global gold reserves to increase, the highest in the survey's 8-year history. A record 43% plan to increase their own holdings in 2026. This is not a reaction. This is a coordinated strategy. The institutions are buying gold because the math on the alternative, holding dollars backed by $39 trillion in compounding debt, no longer works. The transition from Layer 2 to Layer 3 is not a question of if, it is a question of arithmetic. The structural consequence is currency debasement, not a crash, not a collapse, a slow, silent melt, like an ice cube left on a countertop. You do not see it happening in real time. You notice when the ice cube is half the size it was and the puddle has spread across the table. The dollar's share of global foreign exchange reserves stood at 71% in 1999. According to IMF COFR data as of late 2025, it has fallen to approximately 58.5%. That is a decline of more than 12 percentage points in 27 years. It does not happen in a single dramatic event. It happens through thousands of individual decisions made by reserve managers and central banks across the globe, each one choosing to hold slightly less of their wealth in a currency backed by $39 trillion in debt and $1 trillion per year in interest payments. Gold, by contrast, has no counterparty risk. No central bank can print more of it. No government can freeze it through sanctions. A lesson every reserve manager learned when $300 billion in Russian reserves were frozen in 2022. That single event accelerated central bank gold demand from an average of roughly 473 tons per year in the 2010-2021 period to over 1,000 tons per year in 2022, 2023, and 2024. The structural shift is measured in hundreds of tons of physical metal per year. According to the World Gold Council's January 2026 Gold Demand Trends Report, total gold demand in 2025 exceeded 5,000 tons for the first time ever, reaching an unprecedented value of $555 billion. Gold set 53 new all-time highs during 2025, according to ICE Benchmark Administration data. It delivered a yearly return of over 55%. It surpassed $4,000 per ounce for the first time in October 2025. By January 19, 2026, it had hit an intraday record above 4,689 per Bloomberg. By mid-April 2026, it trades near $4,800. Each of those price levels was called the top by someone. Each was absorbed by institutional demand that treated the new price as the floor, not the ceiling. Central banks do not buy gold to trade it. They buy gold to hold it. When Poland's central bank reached its 30% reserve target, it did not sell. Governor Adam Glapiński announced in January 2026 his intention to increase reserves to 700 tons for national security reasons. The direction is set by the arithmetic. The only question is speed. The first is 1971. On August 15th, President Nixon closed the gold window, ending the dollar's convertibility to gold at $35 per ounce. The reason was structural. The United States had printed far more dollars than it had gold to back them. The system broke because the math broke. In 1971, U.S. national debt was $398 billion. Today, according to the U.S. Treasury's April 2026 data, it is $39 trillion, roughly 98 times larger. In 1971, gold was $35 per ounce. Today, it trades near $4,800, roughly 137 times higher. In 1971, the dollar held approximately 85% of global reserves. Today, per IMF COFER data as of late 2025, it holds approximately 58.5%. In 1971, annual interest payments on the debt were approximately $21 billion. Today, per the CBO's February 2026 baseline, they exceed $1 trillion, roughly 50 times larger. In 1971, there was no coordinated bloc of nations building dollar alternatives. Today, BRICS plus nations hold over 6,000 tons of gold, roughly 20% of global central bank reserves, up from 11.2% in 2019, according to World Gold Council data. In the decade following the Nixon shock, gold rose from $35 to $850, an increase of over 300%. The second parallel is 1980, and this one is about purchasing power. When gold peaked at $850 on January 21, 1980, inflation was above 13%. Adjusted for CPI using Bureau of Labor Statistics data, that $850 equals approximately $3,200 in 2026 dollars. For 45 years, through the 2011 peak of $1,921 and the 2020 peak of $2,075, gold never exceeded that inflation-adjusted high, not once. Then, in September 2025, according to Bloomberg, gold surpassed $3,674 and broke through the real 1980 record for the first time. The current gold price is not catching up to past inflation. It has surpassed every previous peak, nominal and real. This is new price discovery, driven by structural forces that did not exist in 1980. No BRICS bloc buying half of official gold, no $39 trillion sovereign debt, no $1 trillion annual interest bill, no digital settlement platforms bypassing the dollar. The current structural setup, by every measurable variable, is more extreme than both 1971 and 1980. The numbers sit on the table. No commentary is needed. In January 2024, gold traded at approximately $2,050 per ounce. The average retail investor looked at that price and thought it was expensive. 2 years of headlines had called gold overvalued. The conventional wisdom said interest rates would stay high, the dollar would stay strong, and gold had peaked. The institutional player saw something different. In the first quarter of 2024 alone, central banks added over 290 tons to their reserves. China's central bank was purchasing gold every single month. Poland was executing its most aggressive gold accumulation program in decades. The institutional money was flowing in, quietly, steadily, and in enormous volume, while the retail narrative said the opposite. By January 2026, gold had surged past 4,689, an all-time high. The retail investor who waited for confirmation, who waited for the media to say it was safe, who waited for the price to come back down, was now looking at a metal that had more than doubled in 2 years. The institutional player who followed the mechanism, who tracked the central bank purchases, who watched the debt math, who saw the reserve currency data, had been positioned for 12 to 24 months before the price confirmed what the structure was already dictating. The World Gold Council's January 2026 report confirmed that global gold ETF holdings grew by 801 tons in 2025, the second strongest year on record. Bar and coin demand hit a 12-year high. But the majority of that retail inflow came in the second half of the year, after gold had already surpassed $3,500. The institutional positioning, the central bank tonnage, the sovereign fund allocations, was in place before the retail money arrived. This is the pattern. The retail investor buys certainty. The institutional player buys the mechanism. The retail investor arrives after the move. The institutional player is positioned before the narrative forms. The evidence does not require commentary. The contrast speaks for itself. Before we get to the signals, tell us in the comments, when was the last time you looked at your own portfolio and asked whether your savings are denominated in a currency that is gaining purchasing power, or one that is mathematically guaranteed to lose it? No predictions follow, no financial advice. What follows are 3 mechanical indicators, publicly trackable instruments that anyone can check. The readings on these instruments are data, not opinion. Mechanical indicator. 1. The DXY, US Dollar Index. The DXY measures the value of the US dollar against a basket of 6 major currencies, published in real time on every major financial data platform. When the DXY declines, the dollar is losing purchasing power relative to other currencies. A sustained move below 100 historically correlates with accelerating gold prices. The DXY fell approximately 6% in 2025. A continued decline below 95 signals the structural debasement described in this mechanism is accelerating. The instrument is publicly available. The direction tells you where the mechanism is pointing. Mechanical indicator 2. Central bank gold purchases. World Gold Council quarterly data. The World Gold Council publishes quarterly reports on central bank gold buying, freely available on their website. The 2010-2021 average was approximately 473 tons per year. The 2022-2025 average exceeded 1,000 tons per year. If quarterly data continues to show purchases above 200 tons, especially from non-Western central banks, the structural demand floor beneath gold remains intact and rising. A drop below 150 tons per quarter would signal a potential shift. This is a reading on the instrument. You can check it yourself. Mechanical indicator. 3. U.S. net interest payments as a percentage of federal revenue. The Peterson Foundation and the Congressional Budget Office both publish this figure. According to the Peterson Foundation's April 2026 interest tracker, Net interest payments reached 18.5% of federal revenues by the end of fiscal year 2025, the highest since 1991. The CBO's February 2026 baseline projects this will rise to 25.8% by 2036. When the government spends more than a quarter of every dollar it collects just to service the interest on existing debt, the mathematical pressure on the currency becomes self-reinforcing. If this percentage continues to rise, the mechanism described in this script, currency debasement driving gold higher, has no off switch. The data is public. The direction is the signal. The mechanism is clear. The United States is adding debt at $7.58 billion per day, per the Joint Economic Committee's April 2026 data, with no structural plan to reverse it. Interest payments now exceed $1 trillion per year, per the CBO's February 2026 baseline, and are projected to double within a decade. Central banks globally are converting dollar reserves into physical gold at historically unprecedented rates. The dollar's share of global reserves has fallen from 71% to 58.5% in 27 years, and the decline is accelerating. Think of a cargo ship, massive, slow. Once it changes direction, it does not reverse quickly. The institutional money is the cargo ship. It has already turned. The gold it has purchased, thousands of tons over the past 4 years, does not come back to market. It goes into sovereign vaults. It stays there. Gold is not rising because of panic. Gold is rising because the institutions that manage the world's reserves have done the math. And the math says the currency they use to trust is being diluted by its own government at a rate that compounds, with no mechanism to stop it. That is not an opinion. That is arithmetic.